Employment taxes, potential personal liability for business owners. Business owners who hire a W-2 employee have certain responsibilities to withhold amounts from the employee's wages and remit those funds to the U.S. Treasury. These funds are called employment taxes and include federal income tax, withholding, and FICA taxes. This money is held in trust by business owners for their employees until it is remitted to the U.S. Treasury. Thus, the coined name trust fund taxes. Trust fund taxes include other taxes such as excise taxes or additional Medicare taxes withheld if the employee makes over a threshold amount in a year. The relevant trust fund taxes to most business owners, though, only include employment taxes. Because the business owner is acting in behalf of the employee, the consequences of delinquent trust fund tax payments fall on the business owner, not on the employee whose taxes are being held in trust. Typical situations where there are unpaid trust fund taxes include the following. Number one, the business owner finds that he or she is in a cash crunch and suppliers and creditors are knocking on the door. The business owner may find it enticing to use the trust fund tax money to pay off these creditors or suppliers instead of remitting it to the U.S. Treasury. Number two, business owners may also find themselves in a delinquent status due to mistakes made by unsophisticated bookkeepers or accountants. And number three, trust fund taxes may be unpaid due to embezzlement by an employee. So, what are the implications to a business owner who finds that he or she is delinquent in remitting the trust fund taxes? According to IRC 6672, a responsible person will be held personally liable for the payment. This means that the IRS can come after the responsible person's personal assets, house, car, bank account, etc. This is called piercing the corporate veil or piercing the veil, which means the IRS can come after your personal assets. So it would be important to understand as a business owner who would be considered a responsible person. The IRM describes responsible person as these things listed below: an officer or employee of a corporation, a partner or employee of a partnership, corporate director or shareholder, employees, a surety lender, or any other person or entity outside the delinquent business organization. That's pretty broad. So here are factors the IRS has looked at in cases regarding delinquent trust fund tax issues. These they look at the status, duty, and authority within the organization of the person, whether the person has the ability to control the purse strings of the organization. It's not necessary to have the final word in the matter as to whether or not you'll pay the trust fund taxes. And they look to whether the person has the ability to take action to make sure the taxes are paid. Also, here are a list of acts that tend towards business owners having responsibility. And you can take a look at the list here. It's not an exhaustive list, but one that where you can get an idea of whether or not you would be considered a responsible person. IRC section 6672 also requires that the responsible person willfully fail to pay the taxes. Willfulness in this regard is defined as voluntary, conscious, and intentional decision to prefer other creditors over the government. And this willfulness does not require a bad motive. So additional implications to being found as a responsible person willfully failing to pay your taxes is that penalties and interest will accrue. And the penalty is equal to the total amount of tax evaded plus interest. So it's quite a penalty. And another serious implication is that penalties are not dischargeable through bankruptcy either for the business or for the individual that is responsible, is found to be responsible. To conclude, IRC section 6672 is one of the most invoked sections by the IRS. So obviously it is an issue. So business owners with W-2 employees, pay your trust fund taxes always. Thank you.